stop everything you're doing right now. Because what's happening in the silver market isn't just another headline. It's a structural shift that could determine who preserves their purchasing power over the next decade and who watches it evaporate. Silver just crossed $93 an ounce. Let that sink in. 12 months ago, it was trading around $30. That's more than 200% gains in a single year. And if you think that sounds dramatic, here's the part that should really make you pay attention. We're not at the top. We might not even be close. I'm going to walk you through exactly what's driving this move, why China just weaponized silver exports, how a 5-year supply deficit is finally forcing the market to tell the truth, and most importantly, what this means for your retirement savings, your purchasing power, and your financial future. But first, let me be clear about something. This isn't investment advice. I'm not telling you what to buy or sell. What I am doing is giving you the information that mainstream media either doesn't understand or doesn't want to explain. Because in times like these, ignorance isn't just uncomfortable, it's expensive. My name is Economics Explained Daily, and this channel exists for one reason: to help everyday Americans, especially those of you who've spent decades building something, understand the forces reshaping the financial world before it's too late to act. Now, before we go deeper, a quick but important request. My analytics show that a huge percentage of people watching these videos aren't subscribed. If you're getting value from this breakdown, take 2 seconds and hit that subscribe button. We're building a community of informed investors who refuse to be blindsided by the next financial shift. And if this video helps you see something you didn't see before, do me a favor and drop a comment below. Let me know you're here. Let me know you're paying attention. All right, let's get into it. On January 1st, 2026, something happened that most Americans never heard about. China implemented new export restrictions on silver. And this isn't a minor policy tweak. This is a strategic move that mirrors exactly what they did with rare earth metals a decade ago. Here's what the new rules actually mean. Starting this year, only large, state-approved Chinese companies can export silver, and they can only do it after obtaining special government licenses. To qualify, a company must produce 80 tons of silver annually and maintain credit lines exceeding 1 billion yuan with state-owned banks. That sounds technical. Let me translate into plain English. Hundreds of small and mid-sized exporters who supplied the global market for years are now locked out. Gone. Finished. And here's the number that matters most. China controls between 60 and 70% of the world's refined silver supply. Let that sit for a moment. Take 30 minutes this week. The country that refines most of the world's silver just told the rest of the planet that accessing that silver is now a privilege, not a right. Elon Musk responded to this news on social media platform with a simple warning, quote, "This is not good. Silver is needed in many industrial processes," end quote. And he's right. But what Musk didn't fully explain is why China is doing this now. There are 3 reasons, and understanding them is critical. First, China is securing domestic supply. Their own demand for silver is exploding. Solar panels, electric vehicles, electronics, medical equipment, all of these industries require silver. And China wants to make sure their factories don't run dry. Second, this is economic leverage. By controlling who gets silver and at what price, China gains bargaining power in the broader trade war with the United States. Silver just became a chip on the negotiating table. Third, and this is the part nobody wants to say out loud, China knows something the general public doesn't. They know the global silver supply deficit is real. They know inventories are collapsing, and they're positioning themselves accordingly. Now, here's where this connects to your life. Every solar panel requires approximately 20 grams of silver. Every electric vehicle uses up to 2 ounces in sensors, wiring, and power modules. Every smartphone, every computer, every piece of medical equipment, they all need silver. And there is no substitute. Silver has the highest electrical and thermal conductivity of any element on the periodic table. You can't just swap in copper or aluminum and get the same performance. So when the world's largest supplier decides to restrict exports, the math becomes brutal. Demand stays constant or grows. Supply contracts. Price adjusts upward. This isn't speculation. This is physics meeting economics. Now, let's talk about something that's been building for half a decade, while most people weren't paying attention. According to the Silver Institute, the global silver market has been in a structural deficit since 2021. Not 1 year, not 2 years, 5 consecutive years. Here's what that means in real numbers. In 2025, global silver demand reached approximately 1.24 billion ounces. Total supply, including mine production and recycling, only amounted to about 1.01 billion ounces. That's a deficit of over 200 million ounces in a single year. And if you add up the cumulative shortfall from 2021 through 2025, you're looking at approximately 820 million ounces of deficit. That's nearly a full year of global mine production that simply doesn't exist. Now, some people hear deficit and think, okay, so prices go up a little, problem solved. Supply increases, equilibrium returns. But silver doesn't work that way. And here's why. Unlike gold, silver is primarily a byproduct of mining other metals, mostly copper, zinc, and lead. This means that even when silver prices double, miners can't easily increase silver output. Their operations are driven by base metal economics, not silver economics. Adding to the problem, new mining projects take 8 to 12 years to develop, or grades are declining globally. And years of low prices meant less exploration, less expansion, and less spare capacity. So when the world suddenly realizes it needs more silver than it can produce, the market doesn't respond with a calm adjustment. It responds with a repricing event. And that's exactly what we're witnessing right now. OCOMEX registered inventories in the United States are down nearly 70% since 2020. London Metal Exchange stockpiles have plummeted to historic lows. Shanghai warehouse levels recently hit their lowest in almost a decade. The physical market is screaming shortage, while the paper market is still catching up. And this brings us to a concept that every investor needs to understand. The difference between paper silver and physical silver. You can trade per silver on exchanges all day long. Contracts change hands millions of times. But when someone actually demands delivery, when they say, I don't want a promise, I want the metal, the system gets stressed. We're seeing that stress right now. Lease rates for borrowing silver in London have spiked, and premiums in Asian markets are running several dollars above Western spot prices. Industrial buyers are quietly locking in supply at any price, because they know their production lines can't stop. This isn't a chart pattern. This is reality catching up to years of denial. Let me ask you a question. When you think about silver, what comes to mind? Maybe jewelry, maybe coins, maybe that silverware your grandmother passed down. But here's the truth that's reshaping the market. Silver is no longer primarily a precious metal. It's an industrial commodity driving the biggest technological transformation in human history. Let me give you the numbers that matter. Solar energy. The photovoltaic industry now consumes approximately 15% of annual global silver supply. Every solar panel contains about 20 grams of silver for its conductive efficiency. According to the International Energy Agency, by 2030, solar and electrical sectors alone will consume half of global silver output. Electric vehicles. Each EV uses 2 to 3 times more silver than a conventional gasoline car. The sensors, the wiring, the power modules, they all require silver's unmatched conductivity. Data centers and artificial intelligence. This is the demand driver almost nobody is talking about. Global IT power capacity has increased by over 50 times since the year 2000. Every server, every processor, every piece of computing hardware uses silver. And as AI adoption accelerates, this demand is only growing. 5G infrastructure. The rollout requires silver in connection components across millions of base stations worldwide. Medical applications. Silver's antimicrobial properties make it irreplaceable in medical instruments and coatings. Now here's the critical insight. This demand is price inelastic. That means factories keep buying silver regardless of price because they have no alternative. Production lines cannot stop. Manufacturers will pay whatever they have to pay. When the Silver Institute released their report titled Silver the Next Generation Metal, they projected that industrial demand will continue growing through 2030 and beyond. This isn't a cyclical spike. This is structural change. And remember what I said about China's export restrictions. China isn't just limiting exports randomly. They're doing it because their own solar panel industry, their own EV industry, their own electronics manufacturing all need that silver domestically. They're choosing their own growth over everyone else's supply. So if you're sitting in America thinking this doesn't affect me, think again. Every product you buy that requires advanced electronics, every car you might purchase in the next decade, every appliance, every medical device, they all depend on a metal that's getting harder to source by the month. Now let's talk about something that professional investors watch closely, but most everyday Americans have never heard of. The gold to silver ratio. This ratio simply measures how many ounces of silver you could buy with 1 ounce of gold at current prices. It's been used for centuries as a relative value indicator. Back in April of 2025, the ratio hit 104 to 1. That meant silver was historically cheap compared to gold. Today, The ratio has compressed to around 50 to 1, reflecting silver's stronger gains. But here's the context that matters. Historically, the mining ratio of silver to gold is about 7 to 1. For every ounce of gold discovered, roughly 7 ounces of silver exist in the Earth's crust. 30 this week. If silver were priced according to that production ratio, with gold at nearly $5,000 per ounce, silver would be trading around $700. We're at 93. Now, I'm not saying silver must reach $700. Markets don't work on simple mathematical formulas. But what this tells us is that there's enormous room for the ratio to compress further if the market begins pricing silver's industrial importance alongside its monetary history. Some analysts are projecting silver could reach $130 in the near term. Others, including major banking institutions, have floated scenarios where silver trades above $300 in a full revaluation. Bank of America recently suggested silver top out between $135 and $309 depending on how supply constraints evolve. Are these numbers guaranteed? Absolutely not. Markets are unpredictable. Pullbacks will happen. Volatility is the price of admission. But here's what the ratio tells us right now. Even after a 200% gain, silver still isn't expensive relative to gold by historical standards. And in prior bull markets, silver didn't just catch up to gold. It overshot. It pushed beyond normal relationships into territory that seemed impossible until it happened. The 1980s silver spike. The 2011 run. Both times, silver moved faster and harder than anyone predicted once momentum shifted. And once that happens, the people who wait for confirmation end up buying the top. Or worse. They sell early because some indicator screams overbought, while the actual move is just getting started. Now let me tell you something that should fundamentally change how you think about this market. Central banks around the world have been buying gold at record pace for 3 consecutive years. Over 1,000 tons annually. But what's less publicized is that some are beginning to accumulate silver as well. Why? Because when you print trillions of dollars and euros and yen, when government debt becomes mathematically unpayable, when the purchasing power of paper currency is quietly eroding year after year, institutions don't just sit there. They rotate into assets that can't be printed. Gold has always been the obvious choice. But silver is joining that conversation. Russia's central bank, under Western sanctions, has been searching for assets that can't be frozen or confiscated. Silver, especially physical silver held outside the banking system, fits that description. And it's not just governments. Major institutional investors, pension funds, they're all increasing allocations to hard assets. Jamie Dimon, the CEO of JP Morgan, recently said something remarkable. He stated that for the first time in his career, investing in gold is becoming rational. And he suggested gold could reach $5,000 to $10,000. When the head of America's largest bank says that, you should pay attention. But here's the part that affects you directly. The same debasement, the same money printing, the same debt monetization that's pushing central banks gold and silver is the exact same force that's eroding your purchasing power. Since January 2020, the M2 money supply in the United States has increased by over 42%. That's nearly $7 trillion created in 5 years. Where do you think that money goes? It doesn't disappear. It flows into asset prices, real estates, and increasingly, commodities like gold and silver. The prices you see at the grocery store. The insurance premiums, the cost of everyday life, that's not random inflation. That's the direct consequence of currency debasement. And historically, the people who preserve wealth during these periods aren't the ones holding paper promises. They're the ones holding real assets. I'm not saying sell everything and buy silver. That would be irresponsible and inappropriate for a channel focused on education. What I am saying is this. Understand the forces at play. Recognize that when institutions act differently than their public statements suggest, their actions reveal truth that words often hide. Now let me address something important. Because if I only told you the bullish case, I wouldn't be doing my job. Silver is volatile. Extremely volatile. And that volatility can destroy undisciplined investors. In the past month alone, we've seen 8 to 10% swings in both directions. That's not for the faint of heart. Here's what typically happens. Silver spikes. People who've been watching from the sidelines finally buy in. Then it pulls back hard. Those same people panic and sell at a loss. Then silver recovers and runs higher. And they're left on the outside wondering what happened. This is the psychological trap. In prior silver bull markets, momentum indicators stayed overbought for months, not days. If you sold the first time your chart screamed take profits, you didn't protect anything. You volunteered to miss the entire move. But here's the flip side. Silver can also crash hard and fast when leverage gets flushed from the system. When margin requirements rise, as they recently did on the COMEX exchange, leveraged traders are forced to liquidate. That selling pressure can create waterfalls that look like the bull market is over. And then, days later, price snaps back as if nothing happened. This is why discipline matters more than prediction. If you're thinking about silver, here's a framework that historically separates those who preserve wealth from donate it to the market. First, never use money you can't afford to hold through volatility. If you need the cash in 6 months, this isn't the place for it. Second, understand the difference between core positions and tactical positions. Core is what you hold regardless of short-term noise because your thesis is intact. Tactical is what you might adjust around major moves. Third, watch the right signals. Lease rates, physical premiums, delivery volumes, inventory levels. These tell you about underlying stress. Price alone can lie in the short term. Fourth, don't let fear of missing out drive decisions. Markets usually offer entries through dips and consolidations. Patience is often rewarded more than urgency. And fifth, have a plan before the chaos. Decide now what you'll do if silver hits $100. Decide what to do if it drops to 70. The worst time to make a plan is in the middle of a sharp move when emotions are running high. So where does silver go from here? Let me give you 3 scenarios that professional analysts are watching. Scenario 1. Gradual climb with volatility. Silver continues grinding higher toward $100 and beyond, but with sharp pullbacks along the way. The structural deficit continues. Industrial demand grows. Investment demand increases. And price reflects reality over time. This is the base case for most institutional forecasts. Scenario 2. Supply shock acceleration. China's export restrictions bite harder than expected. Western inventories drain faster. A delivery failure occurs somewhere in the system, forcing the paper market to reconcile with physical scarcity. Price moves not in weeks but in days, catching late buyers completely off guard. Scenario 3. External shock reversal. A global recession crushes industrial demand. Margin calls force mass liquidation. Silver pulls back 40 to 50% from highs before eventually recovering. This is the bear case that keeps cautious investors up at night. Which scenario plays out? Nobody knows. And anyone who claims certainty is selling something. But here's what we can say with confidence. The forces driving silver higher are structural, not temporary. China's export restrictions aren't ending tomorrow. The supply deficit won't disappear this year. Industrial demand for solar, EVs, and electronics isn't going away. Even if silver pulls back 30%, which it certainly could during a risk-off event, the underlying fundamentals haven't changed. And that's the difference between a trade and an investment. A trade is about timing. An investment is about direction. The direction of silver, over the next decade, appears clear to those watching the math rather than the headlines. Before I let you go, I want to leave you with something important. You've just spent nearly 30 learning about forces that most people will never understand. China's export restrictions, the 5-year supply deficit, industrial demand that can't be substituted, central bank behavior that reveals where the smart money is flowing. That knowledge is valuable, but it's only valuable if you use it. So here's my challenge to you. First, 30 minutes this week. 30 minutes this week and honestly assess your own financial exposure. How much of your wealth depends on paper promises maintaining their value? How much is protected by assets that can't be printed? Second, don't make decisions based on one video. Keep learning. Keep questioning. The peak. People who navigate transition successfully are the ones who stay informed, not the ones who react to headlines. Third, share this information with someone who needs it. Maybe a spouse. Maybe a friend approaching retirement. The people who do well in uncertain times are usually the ones who prepared before the crowd realized what was happening. Now, I have 2 questions for you, and I genuinely want your answers in the comments. First, do you believe silver is still undervalued at $93? Or do you think the market has already priced in the supply constraints? Second, if silver hits $100 and then pulls back 20%, are you the type to panic out or the type to add on weakness? Drop your thoughts below. I read the comments, and your perspectives help shape future content. And if this breakdown helped you see something you didn't see before, hit that subscribe button. We're building something here. A community of informed Americans who refuse to be blindsided by the financial shifts that mainstream media either ignores or misunderstands. I'm Economics Explained Daily. Thank you for your time. Thank you for your attention. Take care of your wealth. Take care of your families. And I'll see you in the next one.